It's the 12th of April 2020. It's Sunday afternoon for me where I am in the world right now, and what I'll be doing is making an educational video on a trading strategy that I've used, as you can see in the screen in front of you, and I'll be going over and I'll be giving out some text boxes, some points to take notes on. Support and resistance will be covered as well. And first of all, what I'd like to do is just to highlight what we're doing here. So we're using a software program called Forex Tester. I'm actually using Forex Tester 3, which I find is a little less clunky than I do have Forex Tester 4 as well. I have an older laptop, which I will be getting upgraded soon. I just honestly haven't, because I haven't really needed to, and I'm a cheapskate, but I do. I definitely need a new laptop. So what I'll be doing right now is just overviewing the situation. So Forex Tester, great platform. I'm not paid to say that either, but I use it because I like it. And it's what I started on with. So what we've got here is a series of trades on the Aussie dollar against US dollar. It's a weekly time frame. I'm using the weekly time frame, guys, just to show you, a zoomed out perspective of the currency pair. Now you're seeing these dashed lines here, and you're probably thinking, Scott, what's going on there? And this just indicates support and resistance. So price, is random in a sense, but it does respect certain points. You have to consider trading from a perspective of buyers and sellers, winners and losers. So what we're seeing here is that this right here is quite key. So right now it's a resistance zone if price is below it. And as you can see, I established this. You've got to obviously have a certain amount of data. I typically let when I am back testing, I'll let the data run for 2 full years, and then I'll zoom out and I'll use the weekly first to get some key levels. Because the amount of data in a weekly candle is it's huge, so it's very significant. If a candle was closing like this, it's quite bearish. But that's just one example of that. So, if it's respecting a level like this, and it does sometimes break out, and then that was a fake out, and then again, and there's so many touches. So what I look for is 3 to 4 touches, on a weekly to make it a real key level. Although right here I would put in a zone right there because it really reacted very strongly. So I'll just put it in there, but it can be adjusted. So if it was to have dropped down and then spiked through, to me it's not significant enough. It sort of tested it, but it broke immediately through, and it didn't even offer a second touch and rejection. So it's not significant enough for me to say, this is a key level. So I'm going to put that in there. We can make it blue, we can make it red. It's just your preference really. So now some key points to take is now I use the crosshairs. The zones have got to be at least 200 pips different, which we don't. We sort of do have that there. So it's got to be at least 200 pips and you also want to take that in consideration with the average daily range. So you can just run an every daily an ADR indicator, and it will work out what the average daily range is. For 2 months, 3 months, whatever your preference. But you'll be able to sort of ascertain. But typically with the Aussie dollar, I found 200 pips was enough difference, because if it's too constricted with the support and resistance zones, you're going to get caught up in the noise of things. Because during day-to-day transactions on the forex markets, you're going to have things go up and down a lot anyway, just with algorithms coming in, and high frequency traders as well. So what we'll do here, guys, we'll just do a test and we'll see if we can we'll go to the daily. So you can run this, even if you, work a normal 9 to 5 job as well. So we'll play an engulfing candle strategy that I like. We'll start the test. And it should start. We'll pause it, and then with each spacebar click, we can get. It's a little slow to react. I do apologize about this, but essentially each time you press the spacebar, a candle will print. Thinking about it. So what we've seen, a couple points, you've seen a few bounces here off this support area at around 77.49. We are back in 2007, and I believe it's the month first as well, so we're in September. I'll keep clicking this. So we're going to see it approach the resistance area potentially. Let's see what it wants to do. In times like this, when it's between zones, you've just got honestly, it's just the noise of the markets, and it's, right there you could have taken a trade. So that will pause the price action right here, and right there is a potential, but the problem is, if let's say you enter, the stop is down at the low here, and it's a bit delayed actually. We'll just let it play out. So the stop is down at the low here, you enter at the high, so you're risking, let's just work this out. You want to take into consideration risk to reward. Let's pause it. Okay, we've got to pause. Alright, so we've got the candle. Let's say we enter at the high, so we'll work out how many pips is it risk. Around 100, 110. We'll call it 110 with spread. And then, so risking 110 to make, around 140. So there's not really a good risk to reward ratio, because when you come up to this zone, you'd expect, like previously, reaction. And there's a lot of uncertainty around this area because you've got conflicting views of traders. You've got traders who are like, well, it's sold off here before. I see excellent selling value. I'm going to get in. Then you have the buyers who are saying this could break out. And you've got a lot of volatility. And it could easily reject and come right back down and stop you out. And then it's not ideal because really you want to win much more than what you're risking. That's just a fair point to make, especially if you're trading the high time frame. So if you've got a day job and you work a normal 9 to 5, it's very difficult to then go home and intraday trade the markets where you're in and out in hours or minutes. It's just very demanding, and I've tried it, and it burns you out. Some people can do it, but it's just, that's why I'm presenting a high time frame strategy, just to help with your well-being and health, because long term trying to day trade the Forex markets is very demanding neurally, and it will burn you out. It will affect your sleep, and long term it can lead to some health issues, and you start really not enjoying yourself, which is not good. And when you're doing that, you start wanting to make money, and you start typically over trading because you're seeking to trade to really get out of the situation, which is not a good mindset to be in. All right, so let's see if we can get a bounce here on this support, if we can get a potential trade. All right, so it's sold off. So this is great. You can set the tempo of how it prints, and you can sort of wait. And right there is actually a strategy that I trade. That's a kangaroo tail. I learned that from a trader called Walter Peters, actually. So that was probably an entry, but we're not focusing on that right now. We're doing an engulfing candle. Really is something like that. So the low engulfs the low of that candle, and the high engulfs that high, and then the candle closes. It closes quite close to the high as well. So that's something. And you'll notice text boxes will come up. Those are stuff that you definitely want to take note of. If you're taking notes, either on your other computer that you're watching on, or if you're stopping the video on a Word document, or if you're writing it down, those are times when you can definitely stop and take notes as well. And so we've seen a breakout. So really the trade was there, but we weren't looking to take a trade on this. That can be for next video in regards to kangaroo tails. But we haven't seen anything print out currently, and I'm just talking strategy. So I'm not talking the live markets right now. You want to understand price action first and the value of support and resistance levels before you go into the live markets, because you're less tempted to take a trade prematurely, because you really want to understand the basics before you think about trading live markets. How I like to think of it is who's trading the markets. Professionals who make a lot of money, who spend a lot of money. They've got institutional information. They've got algorithms that are deployed. There's a lot of resources that they have that we don't. So you want to just take your time and learn a little bit about the markets before